Welcome to Wealth Beyond the White Coat, a show where we dive deep into the world of financial freedom for dentists and medical professionals. I'm your host, Deren, a dentist with a passion for uncovering the strategies that lead to a prosperous life beyond the office. Every episode will explore the avenues of alternative investing, tax mitigation, and secrets to build wealth that the textbooks don't teach you. Whether you're looking to enhance your financial literacy, discover new investment opportunities, or simply find a better way to manage your money, this is the place where your financial health is the core of our conversations. Welcome to Wealth Beyond the White Coat, where your journey to financial clarity and freedom begins. All right, welcome to Wealth Beyond the White Coat. I'm one of your hosts, Deren Flesher, here with my co-host, Ross Brannon, and a couple of tax professionals and investment pros. Ross, why don't you introduce our guest today?
So my business partner, Matt Chancey, is here with us. He is an alternative investing expert, and he's a pretty smart guy when it comes to taxes. And then we have John Harvard, a CPA. Now, John is not like most CPAs. Most CPAs, unfortunately, are compliance focused. They're about filing returns and putting numbers in boxes. But John is different. John does tax planning. He helps clients legally reduce their taxes. So, guys, welcome to the show.
Thank you.
Thanks for having us. I'm just glad we were able to get an Ivy League CPA on here today.
So, John, this is a podcast geared toward medical professionals, very heavy dental. You have clients that are physicians. You have clients that are dentists who own their own practice. Talk about some of the basic things that a dentist who owns their own practice would want to consider as from a tax perspective.
Sure. Just some of the basics. And when you get into some of the blocking and tackling of things, we're not getting overly exotic. We want to find out where the physician or dental or dentist wants to be and personal, kind of what their goals are and those kind of things. But ultimately, we have to start at the beginning. What do we want to set this up as? We want to set it up as a partnership, or we want to set up as an S Corp. What are we doing here? And why are we doing it? Do you have partners or do you not have partners? And those kind of things. So we really start with the setup. Unfortunately, I don't get that opportunity. A lot of folks are moving over from a CPA. And so a lot of times we may have to unwind what they've already established to get them in a more favorable or more efficient setup. So it all starts with the setup. Where are we starting?
Yeah, John. So I'm in Oklahoma, and I was advised to start as an LLC and then eventually move to an S Corp once I grew big enough. Is that the advice you'd give your people? And if not, why not?
Yeah, I would agree. That is a good jumping off place, especially in the beginning. If you don't have a real big book, you don't want to make your tax or your compliance work any more complicated than they need to be. But once you grow, you do move to the S corporation. And at that point, you start to be able to take advantage of saving money on some self-employment taxes and those kind of things. So I would say that's certainly a good approach when you start.
John, for those who aren't aware, explain why an S corporation would save self-employment tax and describe to people what self-employment tax is, what specifically we're talking about.
Yeah, a lot of folks who aren't self-employed don't understand the payroll taxes that have to be remitted. They get a W-2 and they see the federal withholding and the Social Security and Medicare that comes out of their paycheck. As if you're the employee and the employer, you get the pleasure of paying the self-employment tax, the Medicare and Social Security that comes out of your check, but you also get the pleasure of matching it on the other side. So self-employment tax is 15.3%, half the employee pays and half the employer pays. And if you're the owner, you're paying both of them. And as an S corporation, you can take some of your compensation as a salary, which would be subject to the self-employment tax. And then you would take the other as distributions, which would not be subject to the self-employment tax. But the follow-up question I typically get from my clients are, I want to take 100% as distributions. And the IRS says to take a reasonable salary. They don't really deem what reasonable is, but we try to guide our clients on what an appropriate salary is and how much savings that is for them.
And that adds up.
Let me ask a question on that. If I'm trying to calculate my wage base for the S Corp on which side is going to be salary versus a profit distribution, I know this is a long-term thinking out because we're really just talking about the beginning of a business, but
Sure.
that goes into our calculation for how much Social Security benefits we would ultimately get in the future.
It would. So that the Social Security wages that you pay tax on, or the wages you do pay Social Security taxes on, does get calculated in your future Social Security income that you would receive down the road.
If I take less now to pay less payroll taxes and less overall taxes on that higher tax dollar, later when I file for Social Security benefits, I'm ultimately going to get less.
You would get less. Yes. Yes.
Okay. There's
Absolutely.
a
So
trade.
is there like a number where the benefits start to outweigh the costs, or vice versa, with either proportion of your salary or an overall number where W-2 doesn't make sense?
So a couple of things to consider. Another thing to consider is your retirement plan and what kind of plan you're in. And do you need to beef up your salary to max out your retirement plan and profit sharing plan if that's a direction you want to go? And some people are like, that's not a priority for me. I'd rather try to save money in other ways. And that's why really getting to know your client and what their priorities are and what they want to do with their money is important. Some want to put it in a retirement plan and some don't. And so you have to accommodate for that and look for different solutions based on what they want.
Hey, I just want to interrupt real quick and say thanks for listening to the podcast. If you didn't know, we have an associated Facebook group also called Wealth Beyond the White Coat. Over there, you can ask your questions, get feedback from group members, and have a close community of medical professionals who are likely interested in the same things as you. Whether it's alternative investing, tax mitigation, ways to keep more of your money, or even protect your assets, we're going to discuss those things in the group. Additionally, we have a private investors club called Legacy Point. As a member, you'll get exclusive discounts to preferred vendors, and you'll get access to private investments that you'll find nowhere else. Whether it's hotels, apartments, oil and gas, equipment rental, you name it, we'll be discussing those details and offering those investments to members only inside Legacy Point Group. If you want to learn more about that, please contact me or simply email info, I-N-F-O, at legacypointgroup.com or go to the website legacypointgroup.com. And Wealth Beyond the White Coat podcast listeners get an exclusive discount if you use the code WealthBeyond. That's all caps, all together, WealthBeyond at checkout. I'd love to have you in the group, and I'd love to see you making more passive income as you move towards financial freedom, whether it's freedom to retire early, spend more time with your family, go on more vacations, or just do more of what you love while you're in the operatory. I'd love to see you doing that as part of Legacy Point. So here's to improving your financial health.
That's talking about retirement plans. There's all sorts of different retirement plans. There's obviously a traditional IRA, a Roth IRA. There's a simple, a SEP, a solo, a 401k, and then a 401k of profit sharing. Then you get into defined benefit plans. These plans are a great way to defer taxes. When do you feel like it makes sense to do that? Assuming someone wants to set up a plan, and what type of plan makes sense in your eyes from what you've seen?
Like I said, some of the folks I deal with are they want to be not just a dentist or not just a physician or something like that. They want to invest in other things. They have other things that they want to do themselves, whether it be real estate or whatever outside of that. So they need more of their cash after tax to be able to invest versus putting everything pre-tax. Obviously, you can do some things that way too, but it really just depends. And then you have the consideration of not just funding your retirement as the owner, but you have the employees that you have to consider too. When I'm looking at it, yeah, the owner may want to max it out and they're going to get some savings, individual tax savings for that, but they're also going to need to perhaps fund a certain level for their employees to make it legal and pass the 5,500 and all the testing that goes behind the scenes as well. So looking at the different buckets, you just have to consider all the costs that go into it, not just your personal income tax savings, but what's it costing the practice and what are the tax savings on those costs. And so it really, you have to be very comprehensive in looking at all of these things.
And then
Are there either certain thresholds on income or number of employees where one makes sense over the other, or is it preference? Can you give us some insight into that?
Yeah, if you don't want any administration or anything like that, cost a simple would be very, just like the name of it is, it'd be very simple. You'd get to defer a certain amount, and then there'd be a required match that would go along with that to all of your employees who participate. But there's no annual compliance work that kind of falls behind that. Now, you can't defer as much as you would, a few $1,000s less than what you could do in a 401k. But then when we get to the 401k plan, now we're having to get into testing and the discrimination and making sure we fund this thing appropriately. We have the required match for all the employees as well. We're meeting those expectations. In the simple, you're going to have a cost, but it's going to be less. Then you ramp up to the 401k, then you're going to have some more costs, not just in matching the employees, but the compliance work. Then you ramp up a little bit more. You might have a defined benefit plan and things like that you can pump a bit more in there. But again, the testing and all the behind the scenes also costs money.
talk a little bit more about defined benefit plans, what's commonly known as a cash balance plan, about how the census really determines if it works, the age of the business owner that has a very weighs a lot on if it works or not. There's a lot of tax deferral opportunities in that if the census is the right way, correct?
There are. You could certainly pump a lot more into the plan, but again, you have to look at the makeup of your staff. Do you have young folks? Do you have old folks? It's a lot to consider, and it's something that my suggestion is you just have to consider everything when you go into this, not just, oh, I'm going to be able to pump this much money into the plan. You have to consider everything else and what does it mean. Just there's a lot of gotchas out there. Some people are like, I'll just do a SEP and I'm going to max it out 25%. Well, that's okay, but if you have employees who have met the term limit, the 2 years that they've worked for you, if you do 25% for yourself, you got to do 25% for them. That can add up too. But again, it's a very simple approach. But if you have a dentist and he and his wife work in the business and they have a receptionist, it might work for them. But if they have a big staff, that's not going to be much fun.
You guys have any more questions on retirement stuff?
No, I think that really hammers it in pretty well. So, John, we see with a lot of dentists that they have the opportunity to phase into QBI, also known as 199A, qualified business income. And the phase in is in the mid 360s. I looked it up earlier today. I think it's 364, 200, I believe. And so when people are outside or they're phasing out of that, what are ways that they could phase back in? And before you get there, explain what QBI is for those who may not know.
Yeah, so the qualified business deduction is real quickly, one test is whatever your net income in the business is, you get basically a 20% deduction for that is typically where the deduction comes in. It could be 50% of your wages, but it's whichever's less. And typically it's going to be 20% of the net income. But so a $400,000 income, $800,000 or $80,000 of deduction there that comes off of your taxable income. But being in the personal service business, like a dentist would be, like a CPA, our lobbyists weren't as good as the contractors and some of those folks. They don't have a limit. We have a limit that it phases out. And so it's important to consider, especially if you're close, to consider things that you can do to reduce your taxable income to get under that limit and to max out the QBI deduction, because 20% deduction is pretty significant for everybody.
Hey, I just wanted to interrupt the show real quick and tell you about an exclusive member discount for Legacy Point group members. The company is called Gelt, and they're both tax planning and tax preparation. We connected because their CEO actually comes from a family of physicians, and he understands the financial complexities that healthcare professionals face these days. Legacy Point is honored to partner with Gelt because it's our shared mission to empower successful professionals with optimal tax and financial outcomes. For your 20% discount off financial planning and tax preparation and priority access with their onboarding, become a member over at legacypointgroup.com.
That might be a reason to do a qualified retirement plan. As you said, if you're looking at things comprehensively, it's okay. I could put in typically a 401k with profit sharing will get you up into the $60,000 range. You could get in there. That might help. That might help you get down there. And in addition to that, we talk a lot about the 24 to 32% bracket jump, how that's the biggest delta. And this year it's 383,900. So very close to that 364,200. So if I've already done a retirement plan, and what are some other ways that maybe I could tax plan to qualify for QBI fully phased in?
Yeah, you could consider an oil and gas investment, which you could get $100,000 investment. You may get 60 or 70% deduction on that in year one to bring your taxable income down. I had a medical group that they were buying a building, and it was actually just one shareholder, but he decided to buy his building in his S corp. We took the cost segregation and got the practice income down in the practice there, because as long as he was going to practice in that facility. And we were able to do that, do some cost seg in the S corporation there. There's just a lot of different things. I don't know if you want to touch on equipment. That's certainly an opportunity as well.
And what it really comes down to is things are facts and circumstance dependent. So what's good for me may not be good for Deren. What's good for Deren may not be good for you. But you mentioned oil and gas. Matt's got he's pretty knowledgeable in oil and gas and has an extensive history in that. Matt, talk about what we call IDCs, the deduction aspect of investing in an oil and gas opportunity.
To piggyback off of that point, the way I think about it a little bit is, let's assume that somebody's making, if the maximum benefit I can get from qualified business income 199A is at like $365,000, which at 365, if I get to reduce my taxable income by 20% from 365, that's fundamentally a $72,000 deduction from my income. So it takes it just under 300 grand. And all of those dollars are being taxed at 24%. So you're saving 24% of $72,000 in taxes, which comes out to about $20,000 of actual tax dollars saved right around there for getting that maximum QBI benefit. Hey, saving $20,000 in actual taxes that's not a bad deal right there. The issue comes in, I see, is let's assume somebody's making $500,000. They're phased out of QBI, like you were talking about before. They're making too much money. They're phased out. So how do you get a person from $500,000 of income all the way down to $365,000 of income? If you're trying to use qualified plans, and like you said, there's a limitation, $25,000, $50,000. I can't put enough in a qualified plan to get from 500 to get to 365 to get that extra deduction. That's even if I'm using a qualified plan, right? You've got rules to how many contributions you can make based on your other employees. So one of the benefits to a tool like oil and gas is you can right size it, and it's discriminatory. So you don't have to include or let all of your employees use oil and gas. You can just use it for yourself, and you can buy just the amount that you need to match it to the dollar that you need if you want to get down to 360. Let's assume I'm making $600,000 in income. Here's another interesting point, and we haven't talked about it to this point. It's the way I think about planning a little bit, is that if you're making the break point between the 24 and the 32% bracket is around $383,000. If you make $383,000 of income, your last dollar, your marginal dollar, is taxed at 24%. That's the highest end of that marginal dollar. But your effective bracket is basically 20%. You're going to owe 20% taxes on $383,000. If you take 38 and multiply it by 2, you end up with about 76, right? If you reduce 76,000 from 383, you end up at about $306,000 of net spendable income after you pay your taxes. If you divide that by 12 months in a year, that gives you $25,000 a month of spendable income. Most clients I've ever worked with in my career could build a pretty good lifestyle on $25,000 a month of spendable income, making their mortgage payments, their car payments, lifestyle, going out to eat, and all the other things. So I say that from this perspective. I think that's a really good spot to plan to, and that's why the code matches up that way. I think 383, top of the bracket, QBI at 365. Those numbers are all really close and all get you to that lifestyle number of 25 grand a month. But to answer your question, oil and gas has an IDC program. IDC stand for what are called intangible drilling credits. And it's all the things that fundamentally burn off when you poke a hole in the ground. If we're poking a hole in the ground and we're going to pull the fossil fuels out of it, and we're going to sell that commodity into the secondary market, when we're using the sand and the water and the electricity and the piping and all the stuff that goes in a hole and the labor, many of those things are considered intangible and can be deducted. And you can have as a general rule of thumb, some IDCs are less in a program, some IDCs are more. But as a general rule of thumb, I'd say about 85% of the dollars that you put into an oil and gas program are expensable as an IDC. So if you wanted to get to 365 and you were at $500,000 in income, the difference between those is $135,000. And so you would take $135,000 and you would multiply that basically by 115%. And that would tell you the amount of oil and gas that you needed to buy to get exactly to the amount of maximizing your QBI deduction at 365. So we drop you from 32% brackets into 24% brackets and get the most out of your QBI deduction. So there's a way to right size that.
All right, that's going to do it for part 1 of 2 on our tax discussion with both John and Matt. We will air part 2 next week. Thanks for listening in to Wealth Beyond the White Coat. Your time and attention mean a lot to us. If you found value in today's episode, please consider leaving us a review on your favorite podcast platform and share it with your colleagues and friends. Your feedback helps us grow and reach more professionals like you striving for financial freedom. Until next time, keep pushing the boundaries of your financial health. Thank you for joining us on this journey to wealth beyond the white coat.